$1.3 trillion. That's how much it costs to bail out a continent. No, this isn't some science fiction blockbuster plot. This was the reality of the Eurozone debt crisis, a financial meltdown that almost shattered the European dream. But one thing always confused me. How did a handful of countries almost bring down an entire currency union? I mean, how did things get so bad, and who was really holding the bag when the music stopped? So, let's tackle that question. In this video, we're going to explore just how close the euro came to collapse, and the banks that were at the heart of it all. So buckle in, it's gonna be an interesting one. So, before we go into the details, there are a couple of basic facts that we should be using in this video. To understand the crisis, we need to look at the infamous group of countries nicknamed the PIIGS: Portugal, Ireland, Italy, Greece, and Spain. Their name became shorthand for the economic troubles brewing in Europe's southern periphery. The key metric everyone was watching was their debt-to-GDP ratio, which is just a fancy way of saying how much a country owes compared to how much its economy produces in a year. By 2010, these numbers were getting scary. Portugal's debt was climbing past 96% of its GDP. Ireland, hit by a massive banking crisis, saw its debt explode to over 91%. Italy, a much larger economy, was sitting on a mountain of debt worth 119% of its GDP. Spain's was lower, around 60%, but it was growing at an alarming rate due to a housing bubble collapse. But the real poster child for the crisis, the one that set off the first major alarm bells, was Greece. Its official debt-to-GDP ratio was already a worrying 129%, but the real story was much worse. The more debt a country has relative to its economic output, the more of a risk it becomes in the eyes of investors. Okay, let's get started with the ground zero of the crisis. Fans of financial thrillers will know that Greece wasn't entirely honest about its finances. For years, with the help of some clever accounting from major investment banks, it had been hiding its true debt levels to meet the Eurozone's strict rules. The new government that came to power in late 2009 dropped a bombshell. The country's budget deficit was the previously stated 6.7% of GDP, but a staggering 12.7%. It was later revised even higher, to 15.4%. It was a moment of shocking revelation, like discovering the foundations of your house were made of sand. The total amount of concealed borrowing was in the billions, and suddenly, no one trusted the official numbers coming out of Athens. This admission triggered a full-blown panic. The interest rates Greece had to pay to borrow new money skyrocketed. The country, which had borrowed around 300 billion euros by that point, was effectively locked out of the financial markets. It couldn't roll over its existing debt or finance its government spending. The initial bailout package from the European Union and the International Monetary Fund, the IMF, in May 2010, amounted to 110 billion euros. It was a colossal sum, but it was just the beginning. The Greek crisis exposed a fundamental weakness in the Eurozone. The fates of its member countries, and their banks, were deeply, dangerously intertwined. A financial analyst on a forum actually managed to put together a map of this exposure, tracing which banks were holding the most toxic debt. It revealed a terrifying web of connections. This wasn't just a Greek problem. It was a European banking problem. German and French banks were the most exposed. They had been happily buying up high-yield government bonds from countries like Greece for years, seeing them as a safe bet. After all, they were part of the Eurozone. What could possibly go wrong? It turns out, a lot. French banks alone held over $56 billion in Greek government and private debt. German banks were on the hook for around $34 billion. When the crisis hit and the value of these bonds plummeted, these banks were looking at catastrophic losses. It was a chain reaction. A Greek default could wipe out a significant chunk of their capital, potentially making them insolvent. This fear spread from Greece to Ireland, then Portugal, Spain, and even Italy. The value of their government bonds also began to fall, threatening the stability of the entire European banking system. The losses were immense. In the subsequent restructurings of Greek debt, private bondholders, which were mostly these banks, were forced to accept haircuts, writing off more than 50% of the face value of their holdings. Hats off to that analyst, because their map showed the world this wasn't about saving Greece. It was about saving the banks. With the financial system teetering on the brink, the European Central Bank, or ECB, had to step in. It was the only institution with enough firepower to prevent a total meltdown. Up until this point, the ECB had a strict mandate to only control inflation, and the idea of bailing out national governments was considered taboo. even illegal under its own rules. But faced with the abyss, rules were bent and then broken. The ECB, under its president Mario Draghi, unleashed a wave of unprecedented interventions. It began with the Securities Markets Program, or SMP, where the ECB started buying the government bonds of troubled countries on the open market to push their borrowing costs down. This was just the start. The ECB also provided massive amounts of cheap, long-term loans to European banks through its long-term refinancing operations, or LTROs. In two massive waves, it pumped over €1 trillion of emergency liquidity into the banking sector. This was designed to prevent a credit crunch and stop banks from collapsing. Then, in 2012, came the famous whatever-it-takes moment. Draghi pledged to do anything necessary to preserve the euro, and he backed it up with the announcement of the outright monetary transactions program, a potentially unlimited bond-buying backstop. While it was never actually used, the mere promise was enough to calm the markets. The total amount of money the ECB printed and lent through these various programs was astronomical, ultimately amounting to well over €1.3 trillion in various forms of support. But this rescue came at a brutal human cost. In exchange for the bailouts, the PIIGS countries were forced to implement severe austerity measures. This meant deep cuts to government spending, slashing pensions, firing public sector workers, and raising taxes. The goal was to shrink their deficits and regain the trust of the markets. But the real-world effect was a deep and painful recession. The numbers tell a grim story. In Greece, the unemployment rate soared from just 9.5% in 2009 to a devastating peak of 27.8% by 2013. For young people, the figure was an almost unbelievable 60%. The Greek economy itself went into a freefall, contracting by more than 25% over the course of the crisis, a downturn comparable to the Great Depression in the United States. Spain suffered a similar fate. Its unemployment rate shot up to over 26%, with youth unemployment exceeding 55%. The country's GDP shrank for several consecutive years. Portugal and Ireland faced similar, though slightly less severe, economic pain, with soaring unemployment and deep recessions. These weren't just statistics. They represented millions of lives turned upside down, families struggling to get by, and a generation of young people whose futures were suddenly derailed. It was the steep price paid by ordinary citizens for a crisis that began in the trading rooms of global banks and the halls of government finance ministries. The euro was saved, but for many, the European dream had turned into a nightmare.